Kitco Mining special coverage of the Mining Forum Americas is brought to you by Metallo Royalty and Streaming.
Alamos is to divest assets in Turkey. Hello and welcome to Kitco Mining with me, Paul Harris, here at the 2025 Mining Forum Americas in Colorado Springs. Joining me today is John McCluskey, President and CEO of Alamos Gold. John, welcome back to Kitco.
Thank you.
Well, let's start with that. You just put some news out, very interesting news. You just announced the sale of your Turkish development projects for $470 million in cash, which makes a big change to your country risk profile. We'll talk about that in a moment. Why the sale? Why now?
Well, first of all, I would say it hasn't changed our risk profile that much because we wrote the assets down to zero in 2021. So it really hasn't been a factor in our valuation. And we haven't done any work in Turkey since 2019. We were more or less caught between a rock and a hard place in Turkey, given that we were in a situation where it was rather ambiguous as to whether our licenses had been renewed or not. And while the government sort of left us in that ambiguous place, we couldn't really go and work our project. So we did the only logical thing. We launched a bilateral investment treaty claim against Turkey, and that was underway when a better solution to the whole situation for all concerned was proposed by Turkey, actually, and Turkish buyers stepped forward. We were in discussions over the last several months, and we arrived at a price of $470 million, where they agreed to buy, we agreed to sell, and I suppose Turkey blessed the transaction, and everybody came away a winner. So ultimately, the bid claim will be dropped. I think the Turkish mining company ends up with a great asset, and we end up with some compensation for the good work that we did while we were in Turkey.
So a very good win there. $470 million you weren't expecting. The claim gone, so that frees up sort of time and space for the management team and the lawyers. And you can sort of focus on the other development projects, which you've got quite a lot of. So it seems a very good resolution to this particular issue. Now, as and when and if that $470 million comes into your bank account, what's the planned use of those funds?
Well, first of all, I'd say that there's very little risk it won't. Where our counterparty is a very strong Turkish entity. They've provided bank guarantees for the contingent payments. The contingent payments are only contingent on time. The first payment is $160 million on close of the transaction. The second payment is on the first anniversary of the close, and the second payment is on the second anniversary of the close. So that's all very well defined, and they've provided bank guarantees for all of those payments. So I would say very low risk from that perspective. As far as what we'll do with the money, it's pretty clear that for most of our shareholders, it's a bit of a windfall because we haven't talked about Turkey in years. We had written it down to zero, and I don't think anybody was expecting us to announce a sale. We had been very quiet about the whole thing. So what we'll do initially is with that first payment, we'll essentially put it against our $250 million debt. So we'll reduce debt down to less than $100 million. That'll be step one. And as subsequent payments come in, I think there'll be just additional gasoline in the engine for us to essentially build out our growth profile in Canada.
Okay, so using it for something sensible, very good. Now, let's stay on the subject of capital allocation. You produced 137,000 ounces in the second quarter at just under $1,500 per ounce, all-in sustaining costs, giving you a margin of over 50%. Strong cash flows there. How is your capital allocation strategy evolving, John, in this high gold price environment?
I think our strategy more or less speaks for itself. If you look at what we've done over the last decade, for example, we see ourselves, really well positioned with strong assets in Canada and a great growth profile that largely has been driven by tremendous exploration success. So probably the poster child among our assets for that is Island Gold. When we acquired it, there was 700,000 ounces of reserves and maybe another 1 million ounces in resource. it was producing at roughly 100,000 ounce a year run rate. We're in the process through this phase of expansion that we're undertaking. We're going to turn the underground mine into a 2,400 ton per day operation that'll effectively yield close to 300,000 ounces of production. As you know, last year we acquired the Magino project, which we're integrating. What we've done over the course of the summer, for example, is we closed down the island mill altogether, and now we're feeding ore from both mines through the 10,000 ton per day mill that was acquired in the Richmond transaction. So that's just the first step of the integration. Ultimately, what we intend to do is boost throughput in two steps. First to 12,400 tons a day, which will accommodate the additional underground ore that we'll be mining as a result of our shaft completion and the completion of the Phase 3 expansion. But since the acquisition, we're already thinking beyond that. We've got permitted capacity at Island Gold now for 35,000 tons per day. So we ought to grow into that. And it seems pretty logical because not only are you generating more gold production, but you're generating that gold production at a lower cost. Just the economies of scale that you gain from gold will probably take the open pit operation, for example, from the 10,000 ton per day run rate to roughly 17,000 tons a day. And then underground, we're going to boost it beyond 2,400 tons a day to roughly 3,000 tons a day. So on a combined basis, now you're yielding north of 500,000 ounces of annual production. But because of the economies of scale and other synergies that the operations enjoy, we'll be reducing our costs to about $1,100 all-in sustaining costs.
Now that's 35,000 tons a day. That's a large mill. Will you be able to fill it with your operations there?
We're not going to take up the full. That's the full permitted capacity. But we're looking to take it to around 20,000 tons a day. The 17 from the open pit and the 3 from underground. That's a great logical step for us to take.
Well, what's the ultimate vision for the Island Gold complex? Where do you think you can get it to eventually?
That's going to be somewhat contingent on continued success with the drill bit. I certainly don't see that. I don't see that ending anytime soon. I mean, we're having another great year in exploration. We're spending roughly $30 million on exploration at Island Gold. If you look across the company, we've basically added 8 million ounces through the drill bit at a cost of $30 per ounce. So I wouldn't say a really aggressive exploration budget. We have a $72 million budget. That's not necessarily a recipe for everyone, but for us, it's a very good approach because we're so successful in our exploration right now that we're driving value that way. 8 million ounces at $30 an ounce, and the analysts are valuing those ounces much higher than the cost of discovery. So the better point, though, is that you need that large reserve base in order to justify the capital investment that you're going to make in order to increase production and lower your costs and get those productivity gains. So they're kind of all tied together. And when you really come right down to it, a big part of our whole asset allocation strategy, if you will, capital allocation strategy, is driven by our exploration. So that's still part of the DNA of our company, and it's proving to be a great value driver.
Incidentally, John, with the island mill that you've shut down, what's the plan there? Will you sell it? Will you keep it on care and maintenance? I imagine there's quite a market for second or used mills.
Yeah, no, if we're going to keep it on care and maintenance, we'd certainly like that as a backup. You just never know when and if you might need it. So it's extremely low cost to keep it on care and maintenance, as I suggest. But that's no plans to sell it.
Okay. Well, let's talk. Gold prices, high gold prices are perhaps masking the fact that costs are still increasing. Your all-in sustaining cost was down 18% quarter on quarter, but up 35% year on year in the second quarter. What can you and other miners do to put a brake on costs going forward, or is this, cost inflation, cost incremental increase? Is that just something we have to live with?
To be quite frank, our that increase in cost was not driven by inflation factors. It was driven by issues we had at the operation. To characterize them as one-offs, but they were just how should I say? We had a production drill break. We buried 2 scoops. This was at the Young-Davidson mine. So Young-Davidson underperformed in the quarter. We went 14 straight quarters without so much as a blip at that operation. It just worked like a finely tuned Swiss watch. And then we ran into some trouble over the course of a couple of quarters. And if you see all you have to have is like a week of downtime when you're feeding 8,000 tons a day into the mill at these gold prices, it has a fairly significant impact. So the direct impact was what you just pointed out. Our costs were up. And it also happened in the early part of this year. We were mining lower grades at Island and at Mulatos. It just was sequencing. So just a combination of factors, also contributed by another strange one. About 40% of that cost increase in terms of all-in sustaining costs, it was driven by stock-based compensation. Now you'd think, well, management just going crazy and granting themselves ridiculous amounts of stock-based compensation. Well, that's not it at all. It's just a mark-to-market, and our share price had performed so well that it kind of had the effect of, we don't hedge it or anything like that. We're just fully exposed to what's going on in the market. So it had the effect of adding about a 40% increase to our AISC, just driven by that. So those factors will kind of normalize over time, and just with what we're doing in terms of our growth strategy, development of the shaft, which will be completed next year, expansion of open pit mining at Magino, it's all going to contribute to costs coming down in the next few years.
Okay, we've spoken about the plans at Island Gold. We are at an investor conference, and it does seem that investors are now okay with and giving the green light to managements to look for growth again, rather than moving away from capital discipline. Investors want growth again. Aside from Island Gold, where do you see growth opportunities within your current portfolio and also beyond your current portfolio?
Well, within our portfolio, next fairly significant step we're taking is to develop an underground deposit at our Mulatos operation. Right now we're operating from a relatively productive open pit called La Yaqui Grande. It's been in production for about 5 years now. It's just been incredibly profitable for us, and it'll go until 2027. At that point, we'll be depleting the resources there. And what we're going to do is, between now and 2027, we're building a brand new underground operation at the PDA zone at Mulatos, and we're building it's a transition from mining open pit oxides in Mexico to mining underground sulfides. So we'll be going underground to develop PDA, and we're building a new mill in order to process those ores. So all that is going to be getting underway. We received our permit to do that earlier this year, and that really frees us up to develop the next phase of operation at Mulatos. The other thing we've been doing is we've been drilling quite aggressively at Mulatos with a different type of target in mind. Rather than looking for near-surface oxides, we've been looking for high-grade sulfides, and we've been quite successful. There's 2 locations now where we've been drilling and making new discoveries, and those will continue to unfold.
Okay, so with the Mulatos underground and the new mill, what level of capital investment will that require, and what will that do to the mine life or the operational life there?
It's fairly modest. It's about $125 million or so to build out that new production, and it'll generate roughly. It kind of has a profile where it starts out very strong. We'll be probably in the range of about 140,000 ounces to begin with. That has roughly a 7-year run. But what we're doing as we go, generally we would generate more than about 1 million ounces of reserves before we decided to build a mill. But we were somewhat encouraged to go faster on this and take the first 1 million ounces into production, because we didn't want to run out of ore at La Yaqui Grande and then have nothing to do at Mulatos. So we wanted to keep steady production, and so we decided, well, 1 million ounces is a good enough start to get us going. That gives us, 6 years or so in front of us where we'll be pretty steady, and then we're going to continue drilling, because we can continue to expand reserves at PDA. It just makes more sense to expand it once we get underground and do that drilling from underground. But we also have a couple of other areas, including right under La Yaqui Grande itself. We know there's good grade sulfide mineralization under La Yaqui Grande, but we didn't bother drilling it because we weren't working on sulfides at the time. So we've just got so many areas that we can continue to add more sulfide style reserves to mill that we realized we didn't have to worry about how long this is all going to last, because we have such a prolific district there, and our ability to continue to build reserves to feed that mill is probably going to be a pretty straightforward proposition.
Imagine that's one of the benefits of the higher gold prices. And we spoke about capital allocation. The higher gold prices means you can dedicate more funds to drilling, and therefore you can prove up and you can find your ounces and prove them up quicker than perhaps at previous exploration rates. And so that's potential risk of only having 1 million ounces there is less, because you can work faster to put the ounces in place.
Well, we've always worked like that at Mulatos. When we started out production at the main Mulatos pit, we had 6 years of production to begin with. And that was in 2005. So you would have thought in 2005 you're going to run out of resources by 2011. Well, here we are in 2025. 2024, Mulatos had its most profitable year ever. We generated about $230 million in free cash flow. And looking ahead, we still have a decade or more of production in front of us. So the other thing is we've never really backed off. A lot of other companies really pulled in the reins when the gold prices were lower. We kept up with very aggressive exploration budgets, and I think that has a lot to do with why we are where we are. As I said, over the last 6 years, we've added 8 million ounces. Well, that didn't come from thin air. We had to drill, and that we had no less than a $50 million drill budget. Last year it was $62 million. This year it's $72 million. I'd be surprised if it's any less than that next year.
Okay. Let's look a bit at sort of corporate aspects, market aspects. Your shares have increased in value by 64% year on year, which is good, but it is still some way behind some of your peer groups. Some of those are up over 100%. Why do you think that Alamos Gold perhaps isn't firing investor interest as some other companies are?
There are lies and then there's statistics. You can actually use those kind of time frames to generate anything. What you have to understand is we've been outperforming everybody for years, and over a 3-year period, we're up 330%. Last year, we were the only gold stock to make the TSX top 30. This year, there was like 7 gold stocks. Well, why do you think? Well, when you're coming off a low bottom, your relative performance looks great. But when you're just a juggernaut and you've been leading the sector for years, it's really hard. You're going to complain you're up 60%. That's about right, for where we're coming from. So in terms of our valuation, I think our valuation is still a standout and ahead of most of our peers, but they've just been playing a catch-up game. And so as a result, they look like they're outperforming us, so to speak. So
okay, that was perhaps a little bit unfair of me, John. Thank you for picking me up on that. Now, you've done a number of acquisitions in the past, and as I mentioned, the market is now looking for growth again. With the divestitures from Newmont and Barrick Gold, there's been an expansion to the number of gold producers, particularly in the mid-tier category. They're pretty much, a lot of those are single asset companies without a pipeline to speak of. So when you look at the sort of the competitive environment, how do you see that evolving? What do you see coming down the road?
Well, you probably noticed we weren't much of a competitor. We aggressively acquire counter-cyclical. So between 2015 and 2017, we made back-to-back acquisitions. Right? We acquired Young-Davidson, and then we acquired Lynn Lake, and then we acquired Island Gold. Three acquisitions between $1,100 and $1,300 gold. All right, and then we didn't do an acquisition until last year when Magino, despite the fact that gold price had run, the target Argonaut Gold had gone from $4 a share to 22 cents. completely counter to the direction of the market. Well, you can't overlook that. It's still a counter-cyclical buy when you wait for something to come within your price range, and then you make an acquisition. So it's not like we're out of the market, but for us to find the kind of things that represent really good value opportunities, it's a little more tricky, because we're quite particular about what we're willing to pay to get what you're after. And so, what we do is we buy when nobody else is interested in buying. Now everybody's talking about M&A, so we're a lot less interested. And the kind of assets that we already own, we've got to compare the results we're getting by investing in those assets to what we might achieve through acquisition. Well, there's no way anything we could acquire right now could compete with anything that we're currently building.
A good time to take a hiatus. Okay, so a lot going on. What are some of the key catalysts for the company over the next 6 to 12 months that our viewers should look out for from the company?
Well, I would say the main thing is the work that we're doing right now on the next phase of expansion at Island Gold. We produced a base case study. This was something that we more or less promised investors after we made the acquisition of Argonaut Gold. What is that thing going to look like combined? So even though we were already thinking beyond that, we wanted to show what the base case was. And we published that in June, and that's 410,000 ounces of annualized production at a roughly $1,100 AISC. That's a great mine, nothing wrong with that. But because we have we have all that additional permanent capacity, we're not constrained by infrastructure. We got plenty of power. All the things that would typically be issues, we're not constrained in any way. Also, when we sunk the shaft, even though we were planning to start at a 2,400 ton per day run rate, we built the capacity in to go much higher. It basically has a 4,500 ton per day capacity. So we put in that hoisting capacity. Plus, we went down to 1,375 meters. That's the target depth. We're almost there, 25 meters from target depth right now. But we could go as deep as 2,000 meters. The hoist has that capacity. So you always do that. You build in a little redundancy because you never know what's coming next. And with the success we were having in drilling at Island Gold, we assumed it was going to get bigger at some point. But it's just the way is open sooner with the acquisition of Argonaut and the permitting that Argonaut was underpinned by. It's going to allow us to increase production to roughly 3,000 tons a day on the underground side of things. And that will generate something like 400,000 ounces of production. Increased throughput from the Magino pit should bring production up to around 150,000 ounces a year, maybe a bit more. But on a combined basis, we see that mine going to something like 550,000 ounces of annualized production at around $1,000 all-in sustaining cost. So that is a great step forward for that mine. It makes it one of the biggest and most profitable gold mines in Canada, if not the world. And we can fund it. It's probably going to be $350 million to fund that next phase of growth. And it becomes a very exciting platform to support everything else that we're doing in the company, because the cash flows that you generate at, say, a $3,000 gold price, not even $3,600 gold price, if your AISC is $1,000, you've got a $2,000 margin on 500,000 ounces of production. That's pretty good.
Happy days. John McCluskey, thank you very much for joining us today.
Appreciate it. Thank you, Paul.
We have a lot more to come from the 2025 Mining Forum Americas, so hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining special coverage of the Mining Forum Americas is brought to you by Metallo Royalty and Streaming.